I like that part about in turmoil, lots of opportunity, which means that in South Africa, there's a huge amount of opportunity already. And talking to Koki Koiman, who really keeps a close eye on the banks, he mentioned that banks have lent 12% more in the last, most recent quarter, 12% more in an economy that is contracting, one where there is very little confidence. But it talks to your issue of investing. He said it was in renewables. So there's a big opportunity there.
There's a massive opportunity in renewables, and I think we haven't seen a capex cycle globally as big as this renewable cycle that I can think of. So I think people are underestimating how much is going to be spent here, and we're talking trillions of dollars globally, and that the banks are going to be funding that.
So the banks are winners, obviously, from that. Who else?
Well, there's services companies that are going to obviously be involved in servicing this. The one thing I probably would not venture into in South Africa is maybe our construction companies, because their history hasn't been that fantastic, and the way they're structured, they're more in favor of management teams than shareholders. So, but I think there are various services companies, big equipment companies, the Barlows, etc., Caterpillar globally, and there's going to be some new companies that emerge. I mean, maybe some new ones to come to market. There are many solar companies that have extraordinarily done phenomenally well, but they're more in the private equity space, and they're still rolling out funding. And we've seen a few of those come to market offshore. Unfortunately, the market valuations in South Africa are such that maybe they don't want to come to the SA market, but there are a lot of benefiting companies.
You said when you sat down that you had seen a lot of money coming into your funds, but it was due to switching, not fresh. Now, if businesses are investing in solar energy or renewable energy, perhaps they're seeing something there that individuals aren't.
Well, I think that the solar energy investment thesis is a global one, not necessarily a South African one. The speed at which it's happening in South Africa is obviously exacerbated by government. So from that perspective, you're seeing a lot more of it, a lot more companies emerge in a very quick space of time. But it's not filtering into the market, But there are a lot of businesses making substantial money that are in that sphere that we're unaware of.
Here, have you watched the Derrida interview?
Yes.
After watching that and listening to what Stafford says on some of the boards he sits on, that there are discussions now about a complete end of the world scenario with Eskom. The companies that would be doing this investment into being self-sustained would presumably be bringing a heck of a lot of electricity on the grid. Have you done any calculations about where that crossover point is? Because at some point in time, there's going to be just too much electricity in South Africa's market.
Well, I think there's a first problem. The first problem is, when is there enough to counteract what could be happening on the other side, where we go to level 8 or beyond? How long a time period are we going to be in that for? So we think that's around about an 18-month to 2-year period, where there's enough private expenditure having been spent by corporates in the mining, that even if Eskom doesn't get their act together and we lose another couple thousand megawatts, that in 2 years' time, we're talking 2025, mid-2025, there'll be sufficient capacity take-up from the private sector. That's the first part. It's going to be many, many years, we haven't done the work, when that would take over the base load structure. Because bearing in mind, renewables as such they're a supplement. If you look at the global world of energy consumption, it's still 80% base load globally. Coal, old-fired power stations, all the new renewables, clean energy, etc., is not representing a great percentage at the moment. The plan is to grow that, but the base load in the world is so large that it will take a couple of decades to really eat through.
But given the crisis we have in South Africa, and given the recent announcement that anybody can provide any electricity from any source and just put it into the grid, perhaps we'll see some relaxation on that, at least in this market, where we might just see some of these coal-fired power stations being leveraged up.
Yeah, we could. I'll just caution everybody that those coal-fired power stations are very big as a percentage of the grid. They take long to turn around. The structural issues around maintaining those and fixing them is a long-term plan. It cannot happen even if you took the best minds we have globally into a coal-fired power station tomorrow that wasn't working because the furnace is cracked and there are leaks, etc. It could be a 2-year project minimum to fix that. It's not like putting up a renewable project, which you can do in a few weeks. But again, that renewable project is not going to give you the same amount of megawatts you're getting from the base.
So I'm looking for some hope here, and you're not helping me.
It's not a quick fix. So that's why we're saying that the next 2-year period is highly dangerous.
So for South Africans, those 2 years, it's going to be tough. And for South African investors, will that be reflected?
It could be. So assuming that Eskom gets much worse and we have, we're going to 8 or 9 or 10, I don't know where the limit is on load shedding. We're going to see the reaction in the market. But again, the South African stock market is not a reflection of South Africa. There are companies domestically that are listed here, but there are also those that are global companies, the British American Tobaccos, the Richemonts, the Anglos, the Glencores, etc., that are not South African company. So I don't think South Africans have to panic and suddenly move all their money offshore and go and suddenly buy a US dollar tracker, for example, where the US, as I've mentioned, is 3 standard deviations away from its norm. I still think you're okay from an investing point of view. The market is not the economy.
It was interesting that you included Massmart amongst the shares that you shorted, and I'd like to get just a little bit more insight here. I was with my brother-in-law in Game in Pietermaritzburg, and I walked into Game in Pietermaritzburg end of the month, Saturday, and it was empty. Maybe 10 people in the whole of this huge shop, and that to me immediately said, "Whoa, Massmart, they've got to be in trouble." Do you get much? Do you do much of that? Your own eyes telling you about things.
We do that, and we have analyzed. Look, Massmart's now delisted because Walmart's become so embarrassing for Walmart that they've taken their other 50% stake back. By the way, they bought their first 50% stake at 140 Rand, I think it was at the time, or when the Rand was probably 4.5 to 1, so they paid some $30-something, and effectively bought the balance back at about $2 or $3, or it is $4. So they've had a hopeless track record in Massmart. But when we analyze Massmart across the spectrum, and you come across a business like Game, yes, we see what's happening with Game. It's absolutely fixed into all these long-term leases at these big shopping centers with too much space, and their product set has been totally cannibalized. You can imagine what Takealot, for example, has done just to the Game brand alone. And unfortunately, they tried to turn that Game business around year after year. Promises were made every year, and it's never been fulfilled. It's been a loss-making business, I think, for the past decade.
So, but my point there is that each of us see things on a day-to-day basis. Maybe you have a Coca-Cola and you think, wow, this Coca-Cola is great. Nothing's better than Coca-Cola. I should buy Coca-Cola shares. How much of that comes into your process?
No, very much. I mean, we're always out there reading, looking, experiencing what we can. I mean, you don't have to, be a genius to go to Sandton City and stand outside the Louis Vuitton store and see that's very different to the Game store in Pietermaritzburg, with a queue round the corner and the product set being quite more expensive. And it's one of the reasons we own LVMH in our hedge fund, actually, and in our global funds, because it's an aspirational brand company, and it's not like a Game.
Do you own a stock like Grindrod, given this privatization by stealth in South Africa?
Absolutely. In fact, we almost own, I could be mistaken, but I think we almost own 10% of Grindrod, the company. And we bought it over the last couple of years. We've doubled our return for it. We made 100% at least. We started buying it at 5, 6. and results. There was an update out now. From an EV, EBITDA, I don't want to get too specific, valuation point of view, it's very cheap. And if you look at some of the deals done on other African assets that had ports or logistics businesses, they've done at multiples of what Grindrod is worth. So somebody at some stage is probably going to come for a few of those assets. We like that business. It's cheap. It's doing well. Earnings are growing. And it's businesses like that, for us are pure value plays that are good. It's small, so it's taken us a while to build enough of a position there as well. But even we've got a decent position.
And it's part of the whole Remgrow operation. I haven't heard that being spoken of for many years, and yet I do recall that Remgrow was often referred to as it's the kind of, you go and buy that stock and just forget about it and it'll outperform everything over a long period of time. Is that something that's on your radar?
So Remgrow is as well. We have been buying some of late. I think it's really because of you need a catalyst for something like a Remgrow trades at a 40% discount to its underlying holdings in its various investments. And a lot of those investments historically had been listed companies, First Rand, Discovery, RMB, Distillers, Grindrod, etc. But they've made a stated intention to change that objective to become rather invested in unlisted businesses that have higher growth profiles, and probably more outside of South Africa. So we think that discount will narrow. We know they're about to sell will reinvest actually in the distillers business. We wouldn't be surprised to see more of an unbundling of the listeds. So we expect that discount to narrow. And probably, I think it will do well versus other financial businesses because you're starting off with, again, value on your side with a 40% discount.
Now, the point for those who aren't like investment experts, when you say the discount, does that mean you're buying a rand's worth of assets for 60 cents, effectively, at a 40% discount? So the REIT, the Cape Town property company, Spear, would that be another one that you'd look at on the same basis?
In Spear, it's probably a little bit too illiquid for us, but, that's exactly the same argument. If Spear's worth, trading at a 40% discount to what it could sell its assets at, and it's in a disposal phase, and it's paying you a yield, I believe, instead of 14% or 12%, that's a value play.
We're learning a lot today. We also know that Pitt's not a fan of Cathy Wood. We know that Stafford thinks Cathy Wood is conservative when it comes to Bitcoin. Where do you stand on that?
We are short Cathy Wood.
You are short.
We have been short. We have made money on the Cathy Wood collapse of her ARK-K and ARK-F, various listed companies that she has, which is a conglomeration of fast-growing tech companies that she has in an ETF. So you're able to borrow that ETF and short it, and if it does collapse, which it has done by about 70%, you effectively can buy it back at 30% and make that 70% return. And we are still short ARK. And ARK, we started shorting at $130. It's now at $39.
And you're still short?
We're still short.
Where's the bottom?
A lot lower. Its biggest holding, by the way, is still Tesla. Those of you who followed Tesla's Investor Day, which was last night, our time, I was online reading while you all went to bed probably. The Investor Day was an absolute flop. No new products really, talking generic stuff about cutting costs. I see the shares down 6 or 7% pre-market. And that's Cathy Wood's biggest stock. And she's got some bullish models showing Tesla worth, $2,500 a share. Tesla's going to earn much less this year than it earned last year. The Chinese have caught up with their technology. All the other first world car companies have caught up with their technology. Tesla models are old and tired, and unfortunately they're not going to do the volumes that they think, and they've had to cut their selling prices across the board twice and shut down factories. Means your gross margins are going to contract, your operating margins are going to contract. They're going to earn less this year. So it's not a growth company anymore. So if I asked you if something earned $4 a year and it's now going to earn, say, $2.50 this year, and it's slowing, what PE would you put that on? I don't know, you tell me. What, 20 even to be generous in America?
8 to 10?
Well, 8 to 10 means you're getting it $20 to $25 share price on Tesla. It's trading at 200. So to me, it's a cult. It's a great following. Elon's a fantastic character. He's funny to watch. I read hours and hours of Twitter a day, probably minimum 4 hours just in Twitter. But if you're going to base a company on what it's fundamentally worth, it's worth maximum, I'd say, an eighth to a fifth of what it's trading at.
And that's the big problem, isn't it? When you get an exponential growth company that's growing at 20% plus, it gets valued accordingly. But when it stops growing, people forget to rebase their valuations as you've just done now.
Absolutely.
Are there others like that?
I think there are a lot. I mean, we're short like Zoom, for example, which obviously did fantastically well during COVID. But if you look at the numbers that came out a couple of days ago, revenue is not growing. And for the last 10 quarters, revenue is flat. Marketing costs are high and earnings are not growing. Yet the company valuation is still out there at $25 billion for an app that Teams can do the same thing for, that you can include in your Microsoft package. And now they're talking about moving their cost structure to China. I don't know. I think there's, unfortunately, in the US now, I've been wrong for the last few months because I really thought the US would be coming off already. Has kind of started the last week or two. I thought it would have taken much quicker because you've never seen a spike like this in interest rates, which is causing obviously a much higher discount rate, which means your valuations should fall a lot, and they haven't fallen at all. So operating profits are were unsustainably high during COVID. They're falling. The discount rate's now rising, but yet the market's carried on going up. And a lot of these companies don't have sustainable business models, don't have the cash flows. But it's a problem with the US market. Some of it is actually what we call gamed. It's gamed on option trades. I'm not going to get into that in detail, but it's almost not realistic. There's a whole lot of retail traders who head one way, and you know what happened in GameStop and those companies. But I think it actually happens in many of the bigger companies as well, like Tesla. So eventually when that all runs out, I think the market's got a long way to fall.
Questions? Hands up, please. There we go. A couple in the front here. While we're waiting for the microphones to come through, are there exceptions to this? Are there exponential companies that are still growing exponentially?
I think there are, and there are very interesting consumer-facing businesses. But I think we've come out of a period that's been so skewed by the amount of Fed stimulus, this $31 trillion balance sheet, that it's hard to believe, that you're going to find many of those in the current cycle. It's going to be more about the value cycle, more about finding companies that are cheap, low PEs, decent dividend yields. And if you had to ask me right now, like, what's the safest bet? I'd tell you right now, you can earn 5% in the US market on short-term treasuries, government treasuries in dollars. That, to me, from a risk perspective, is actually a good trade. Yes.
So, but Bruce Dacres, thank you for a very interesting presentation. You talk about the US rolling over and what you were speaking about right now with Alec. What is it going to look like? I mean, are we looking at something cataclysmic like 2008? Or is it just going to be a rectification? Where's it going? Because it looks the worst than what I think I've ever seen it. And where's it going to end, and what are the implications for us?
So it's funny, it looks to us more like not a 2008 where you had an event. You had the Lehman's event, you had this housing bubble with all these AAA. Will you have an event like that? It's possible that could happen. And maybe that's in property again, in office, for example, in the US. I was there 2 weeks ago, and I was in the capital of Atlanta, Buckhead, with all these enormous buildings. Microsoft are there, Merrill Lynch and whatever. And it was lunchtime, and the buildings were dead. It was like being in Santon during COVID. And I was thinking, wow, these buildings. So that it could be an issue like that suddenly comes to the fore, and various banks have got too much exposure, or But I think it's more going to be around like the 2000 to 2003 year post the 2000 bubble, where if you look at what happened, for example, in NASDAQ, it lost 75%, but it actually lost it with all these enormous spikes. And there were about 3 or 4 45% spikes from bases over that 3-year period. And we've seen a couple of those. We saw one right now that's just, NASDAQ was down and bounced some almost 30% from 10,000 to almost 13,000 again. But bear in mind, it started at 16 or 17,000. So I think we've got that, we're in that type of downward market trajectory. We've just been through a bear market bounce. I wouldn't be surprised if we, head a bit lower, and hopefully that's the way it plays out without a massive shock.
Mick Goss, forgive my naivety, but if you live outside Moy River, you call yourself in the mainstream. What I wanted to know was, who is out there, other than the mines, who is investing as much money as we're talking about in renewables and other energy sources? And the other thing is, who would be crazy enough to buy a piece of Transnet at the moment?
No, there definitely would be takers for pieces of Transnet. They probably would want some guarantees from government around security, etc. And then I'm not an expert on how that would happen, but there's some very valuable assets in there. And the mining companies need Transnet to operate efficiently, so that there is will to make that happen. Besides the mining companies spending on renewables, shopping centres, for example, trying to go off the grid. They've got massive space on top, buildings on top. We're seeing a lot of renewables in that space. And the biggest problem really is for manufacturing businesses. They really struggle the most. So there, I think, is a difficulty because the amount of power that's required. It's difficult to get a renewable source to provide that. So they're still using massive diesel generators, which aren't environmentally friendly and cost a fortune to run. So I think there are large parts of businesses, offices, shopping centres, less manufacturing dependent businesses, services businesses that are investing a lot. I mean, those in this room, I'm sure how much residential investment there's been in batteries and solars and inverters just in this room over the past year, I'm sure is quite a significant number. So it is happening, but obviously in mining, it's critical. And, they're globally enormous businesses, the likes of a Glencore, earning something like $36 billion a year. They can afford to spend money. Billions of dollars doesn't really make a dent.
So we'll see you in a little while for our panel discussion. Thank you very much.